vital role when evaluating the health and performance of a company. That's EBITDA. You might have heard this term tossed around in financial discussions, read it in annual reports, or just seen it in stock analyses. But what does it really mean, and why is it so important? More importantly, why is it often considered the most accurate metric for determining a company's financial health? Let's take a look at these questions in detail and understand the actions that companies can take to improve each component of EBITDA to ensure their financial well-being. So what is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a measure of a company's overall financial performance and is used as an alternative to simple earnings or net income in some circumstances. To break it down, earnings is the net profit or bottom line of the company after all expenses have been deducted from revenues. Before, this indicates that certain expenses have been excluded from the earnings calculation. Interest is the cost of debt or the expense incurred from borrowing money. Taxes are the corporate taxes a company needs to pay. Depreciation refers to the reduction in value of tangible assets over time due to use, wear, and tear. And amortization, similar to depreciation, amortization is the reduction in value of intangible assets over time, like patents or goodwill. By excluding interest, taxes, depreciation, and amortization, EBITDA focuses on the operating performance of the company. It provides a much clearer picture of a company's operational profitability by removing factors that may not directly relate to its core business activities. EBITDA is important for several reasons. It allows investors and analysts alike to compare the performance of companies within the same industry, regardless of their capital structure, tax situation, and asset base. This is because EBITDA eliminates the effects of financing and accounting decisions, providing a more apples-to-apples comparison. It highlights the company's operational efficiency by focusing on earnings generated from operations before the impact of non-operational expenses. EBITDA can be a good proxy for cash flow from operations, as it excludes non-cash expenses like depreciation and amortization. It's often used in valuation metrics like the EV to EBITDA ratio, which helps investors assess whether a company is over or undervalued relative to its peers. While no single metric can give a complete picture of a company's financial health, EBITDA is usually seen as a reliable indicator for several reasons. By excluding interest, taxes, depreciation, and amortization, EBITDA provides insight into the company's profitability significantly impacting costs. For cost control, streamlining operations and processes can reduce costs. This might include implementing lean manufacturing techniques or optimizing your supply chain management structure. Outsourcing non-core activities can help to reduce overhead costs and improve operational efficiency, and negotiating better terms with suppliers and vendors can help reduce the cost of goods sold as well. For expense management, there are fixed and variable costs. Managing the balance between fixed and variable costs can improve EBITDA. Reducing fixed costs like rent and salaries can be beneficial during downturns. Investing in technology that improves productivity can also lead to long-term cost savings. Ensuring a company's financial health involves regular monitoring and management of EBITDA. Some steps that companies can take are performing regular EBITDA analyses to track performance trends and identify areas for improvement. They can compare EBITDA with industry peers to gauge competitive positioning and identify best practices. They can use EBITDA as a key metric in strategic planning and decision-making processes. They can also communicate EBITDA targets and achievements to stakeholders to build confidence and try to attract more investors. So, wrapping up, EBITDA is a vital financial metric that provides a clear and focused view of a company's operational profitability. By excluding the effects of financing, taxes, and non-cash expenses, it offers a more accurate measure of a company's core performance. While it's not without its limitations, EBITDA is a valuable tool for comparison, investment analysis, and strategic planning. Improving EBITDA involves enhancing revenue, controlling costs, and managing expenses effectively. By doing so, companies can ensure their financial health and achieve long-term success. Well, I hope this has been a short and sweet intro to the subject